Welcome to vTalkInsight / U 2013 Allocators Lens Daily for March 9th, 2026. Cross-asset focus today is on whether a deepening Gulf energy shock is nudging the macro mix from benign disinflation towards stagflation, just as U.S. labor data weaken and markets push back expectations for rate cuts. Let's start with how that tension is showing up in global equities. In equities, the headline story is resilience, but the undercurrents look far more fragile. U.S. indices have held up better than you might expect, given a near 40% weekly surge in oil and rising geopolitical risk, with the S&P 500's recent 5-day range staying tight and technical support levels still intact. Yet the latest weak jobs print and oil spike triggered a broad sell-off, with the index down over 1% on the day and nearly 400 constituents finishing the week in the red as the VIX moved toward 30. Beneath the surface, allocation is rotating rather than exiting risk altogether. There has been a notable shift from global equities into U.S. names, with U.S. stocks on track for their best week since April last year at one point, underscoring a renewed preference for the U.S. as a relative safe haven. Within the market, investors are gravitating toward high-quality companies with strong balance sheets and capital expenditure plans, while cyclical losers from the energy shock, such as airlines, have entered a bear market, down more than 20% since early February. Factor behavior reinforces the sense of stress and dispersion. Momentum underperformed sharply this week, with low momentum stocks beating high momentum by around 5%, and semiconductor stocks are down about 7%, pressured both by higher yields and fresh headlines on potential export licensing for AI chips. At the same time, traditional defensive and low volatility factors have not clearly outperformed, which suggests risk appetite is bruised but not broken. Strategists increasingly describe equities as fully valued, even as some houses still expect double-digit gains into year-end on the back of above-trend GDP growth, strong earnings, and upgrades to industrials tied to defense, electrification, and AI infrastructure. Against a backdrop of rising oil, softer labor data, and higher volatility, the risk-reward skew for broad equity beta looks more asymmetric, with scenarios of a further 5 to 10% drawdown if Brent lurches above $100 or even $120 per barrel. For allocators, the watch points are simple but critical: the path of energy prices, any sign of earnings margin compression from higher input costs, and whether today's defensive positioning and record equity hedging are sufficient to absorb another shock before we move on to rates. Rates markets are now squarely focused on inflation risk rather than growth scare. Expectations for the first Federal Reserve rate cut have slid back to September. In some jurisdictions, markets have even flirted with the idea of renewed hikes as oil climbs and inflation remains above target with little progress over the last 2 years. U.S. 5-year inflation break-evens have reached their highest level since last March, and long-dated treasuries are enduring one of their largest weekly sell-offs in more than a year, with yields on the long end moving sharply higher. The macro data feeding into this repricing are mixed and awkward. On one side, non-farm payrolls unexpectedly fell by around 92,000 in February. Unemployment ticked up to 4.4%. Retail sales were soft, and labor market gains are concentrated in a narrow set of sectors, leaving roughly 80% of the economy with flat or negative job growth. On the other side, strong ISM manufacturing and services data and robust estimates for first quarter GDP above 3% suggest activity is still solid, which reduces the urgency for immediate easing. Fed officials are signaling a likely pause at the upcoming March meeting, and some appear more worried about inflation persistence than their public tone implies, raising the risk of policy staying tighter for longer despite softer employment trends. For portfolios, this leaves bonds in an unusual role. Recent energy-driven inflation shocks have meant that global sovereigns have not always provided the classic diversification benefit when equities wobble, and the latest oil surge has pushed shorter maturity treasury yields higher as well, even as some see 10-year yields as fairly valued in a 3.5 to 4% range. Yet inflows tell a different story. Fixed income exchange-traded funds have already attracted about $110 billion this year, for times their usual pace and double the prior record, reflecting a strong rotation toward more defensive liquid exposures. The working assumption in many asset allocation discussions is that high-quality duration will regain its hedging power in a deeper risk-off episode, but the pattern may remain volatile as long as oil and break-evens dominate the conversation before we turn to credit. Credit markets look deceptively calm at the surface, but the real stress is building in private channels. One of the most striking developments is renewed pressure in private credit, highlighted by BlackRock's decision to gate redemptions amid rising withdrawal requests and coming on the heels of earlier high-profile fund collapses. These vehicles have been a key driver of U.S. growth and are closely linked to banking channels. So the gating has sharpened questions about liquidity mismatches and potential systemic risk if more funds are forced to follow. On the public side, spreads have not blown out, but the tone is clearly more cautious. Some allocators see equities as fully valued and are adopting a more defensive posture, expecting that credit spreads could widen further from here, especially in lower-quality issuers and sectors directly hit by the energy shock. Airlines and travel names, which are already in equity bear markets due to surging fuel costs, illustrate how quickly fundamentals can deteriorate when oil spikes and demand risks rise at the same time. At the same time, large inflows into high-quality fixed income and duration suggest a preference for liquid, transparent instruments over gated private structures. There is a growing view that in a genuine risk-off event, these higher-quality bonds will again serve as portfolio hedges, even if they have lagged in the current inflation repricing phase. The key variables to watch in credit are redemption activity and pricing in private funds, the behavior of bank funding spreads, and any early signs of stress in energy-exposed or highly levered borrowers as the oil shock and higher yields filter through the system, which brings us naturally to currencies. In foreign exchange, the signal is remarkably clear. This is a dollar-centric shock. The U.S. dollar is on track for its strongest week since 2022 and is widely expected to keep outperforming as the primary safe haven for as long as the current geopolitical conflict and energy disruption persist. Demand for dollar-denominated assets is being reinforced by the U.S. position as a major energy producer, the prospect of higher relative growth, and the perception that U.S. inflation may be less sensitive to this particular oil shock than that of major importers. By contrast, traditional safe havens have not delivered the usual protection. Government bonds, the yen, and the Swiss franc have all struggled to keep pace, and gold has shown more downside than upside unless the conflict escalates significantly, leaving the dollar as the dominant refuge. For the rest of the world, that combination of higher oil prices and a stronger dollar tightens financial conditions, particularly for energy importing economies and for borrowers with dollar liabilities, while Europe's increasing reliance on U.S. liquefied natural gas only partly mitigates the shock. For allocators, the cross-asset takeaway is that currency risk has become a more central channel of transmission for this energy crisis, setting the stage for the commodity story that underpins it. Commodities, and oil in particular, sit at the heart of the current regime shift. The effective closure of the Strait of Hormuz amid escalating conflict has slashed tanker traffic from roughly 40 ships a day in January to just a single tanker on some recent days, and there have already been periods where oil shipments halted completely for 24 hours. Up to 20% of global seaborne crude, or around 16 to 17 million barrels per day, is at risk, and pipeline alternatives can only partially offset the loss, leaving Asian buyers and regional refineries scrambling for supply. Price action reflects that severity. Brent has pushed above $90 per barrel, West Texas Intermediate is trading in the high 80s, and by some estimates oil is up nearly 40% this week alone, driven by both genuine supply disruption and a sharp short squeeze that has narrowed the spread between benchmarks. Jet fuel prices in Singapore have surged above $200 per barrel, with some reports closer to $250, forcing refinery cutbacks and contributing to soaring diesel and gasoline costs. Major houses have lifted their Brent forecasts by $10, and if the disruption lasts several more weeks, scenarios of Brent above $100 and, in a worst case where exports halt, even $150 per barrel are now on the table. The macro implications of that kind of move are inherently stagflationary. Sustained oil above $120 per barrel would materially raise U.S. recession risks and amplify existing labor market weakness, while also pushing inflation further above target at a time when it has already run hot for 5 years. Current disruptions are described as larger than those seen during the 2022 Russian crisis, raising the prospect of rapid demand destruction and a higher structural risk premium for energy. Policy responses so far look constrained. The White House has been reluctant to draw immediately on the Strategic Petroleum Reserve, even as it grants waivers for Indian refiners to buy Russian crude in an effort to reroute supply, and Europe's diversification away from Russian gas toward Norway and U.S. liquefied natural gas helps, but does not fully insulate it from global price spikes. For portfolios across asset classes, this means tracking real-time indicators like tanker traffic, refinery run rates, and refined product prices alongside central bank rhetoric, because the duration of this energy shock will largely determine whether today's environment settles as a temporary inflation scare or hardens into a sustained stagflation backdrop. Before we wrap up, pulling the threads together, the cross-asset picture is one of an energy shock colliding with still solid but more uneven growth and a gradual shift towards stagflation risk. Equities remain surprisingly resilient at the index level, yet widening dispersion, factor reversals, and pressure on energy-sensitive sectors show that the cost of capital and the cost of fuel are starting to bite. In rates, oil-driven inflation fears have pushed out the timing of Fed cuts and lifted break-evens, while large inflows into liquid fixed income hint that many allocators still see high-quality duration as their primary shock absorber. Credit is where liquidity and solvency questions quietly intersect, with private credit gating and expectations of wider spreads contrasting with continued demand for transparent, tradable bonds. In foreign exchange, a strong dollar and muted performance from traditional havens underline how this shock tightens conditions for energy importers and dollar borrowers, even as it supports U.S. assets. And at the core, the persistence of disruptions around the Strait of Hormuz will dictate whether today's oil spike remains a painful but temporary disturbance or evolves into a longer-lasting stagflationary regime that forces a broader repricing across all asset classes. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.